to another Straight Up Tuesday tip. I'm 𝗤𝗏𝗀𝗀𝗃. With me, as always, is Mark Ainley. And back with us is our friends from 𝗲𝗏𝗃𝗀𝗁 Group. But we have two different gentlemen with us. We have Jeff Leibovich and Ron Plonis. I almost messed it up again. I'm sorry, buddy.
It's okay.
Ron was one of our early guests too. Like you're like
guest number 4.
Number 4 podcast.
Number 4. We're now on like 140 something when this airs. Number 4, original gangster.
Yeah. Well, I don't know if that's a good thing or bad thing because I haven't been invited back yet. So it was either early mistake or your network.
All right, now we'll get you back on. Now the balance been thrown. All right, so you guys talk to sellers, you talk to buyers all day long. That is your job. You know, a lot of sellers are looking in this extremely hot market, seeing, oh my gosh, down the block traded for X. I will gladly trade. I will gladly sell my building for X. And they have a conversation with you. But what are some things investors need to consider if they're going to sell or dispose of their asset?
Well, that's a long question. So it really varies a lot based on the size of the asset. So if you're dealing in, 6 to 32 unit neighborhood buildings, there are, a handful of metrics that you can really rely upon to value that building. As you go up market and you have newer construction, newer developments or mixed use or garden complexes, there's a lot of other factors that come into play. So I guess
let's start with the small ones then. Let's start. I come to you. I have a 12 unit. I saw, a 10 unit down the block that just traded at some number that I said, hey, I'd be happy to get that number.
Yeah. I mean, if it's in a similar, let's set the city aside. We focus mainly on suburban Northwest Indiana and Midwest properties. We do work on Chicago properties, but only when they're newer developments typically.
And just to be clear, that's you. That is you too, not 𝗲𝗏𝗃𝗀𝗃 as a whole, just for our listeners.
Yeah. So 𝗲𝗏𝗃𝗃𝗀𝗃 is configured in there's teams and they focus on different areas. For the Chicago, there's teams that focus on different geographies, and then there's a suburban team, Matt and Danny, and then Jeff and I. We focus on really 2 types of product, but all across. It just doesn't happen to be a lot of it in the city, so that's why we're more suburban. But anyway. Setting Chicago aside or looking at Chicago, if it's a very similar submarket, so you're in Portage Park, it's 12 units, it's around the same size, same area because it's street by street in Chicago, price per unit, price per square foot, and cap rate, the go-tos really work. In, larger deals where people are buying yield, and placing capital, you're going to be looking at IRR and unlevered and levered IRR based on if it's a new development or if it's a garden complex, a 400 unit garden complex that you're going to be adding value to.
Got it. So if I'm an owner of, let's say, one of these larger buildings, I have some 120 unit building. What is step one, right? You've probably been calling on me for 2-3 years. I've shown a little bit of interest. Just walk us through that, because I think a lot of our folks here, we're more on the buying side, right? So I think if you can give us a little behind the scenes magic of how you set that person up for success, that seller up for success, that'd be awesome.
Yeah, first point, I think calling people for years, we do want to call everybody, but we have I don't know if it's a different philosophy, but our philosophy is that we only call people when we have something to provide them. We're not making outreach or cold calls, asking people to sell their building. We get assignments, we learn something about the market, then we reach out to all the owners in the market with similar property to share what we've learned, share what we're doing, and provide value. I mean, I think Jeff can attest. It's because Jeff is a principal in a pretty large development, and time is really the commodity. So I don't know if you want to share anything.
Yeah, no, look, we try not to be, hey, are you ready to list your property? Hey, are you ready to list your property? Like Ron said, as we're analyzing or valuing a property for someone and we're seeing what the market rents are or what the rent trends are, or even as we speak to the capital markets and see where rates are going, which has an effect on property values, we want to fill the principals in and the owners in on where the market sits.
Yeah, I mean, and I'll answer your question at some point, but it reminded me of a funny story. I was talking to a client of mine that's been a client even back to the SFR days, but now he's a multifamily. He has a portfolio, and now he's doing multifamily development. I called him and I said, hey, I'll leave his name out. And he goes, what, did my name come up on your system? I go, yeah. I do use those systems, and it does tell me to call people, but I go, but when your name comes up, if I don't have something to share with you that you can actually use, I won't call. That's, I think, how we try to, I don't want to say differentiate because that's such a misused term, but that's kind of our approach to the business, is that we're coming to help. And we know that if we continue to do that, listings will come, development deals will come. Got it.
So we get to a point.
Not what the question was.
As a seller, you start having those conversations. You build trust over period of time. They're then looking to sell. Mm-hmm. Talk us through, what are some of the things that are overlooked there? I assume everyone thinks their property is worth more than it is, right? Even on the smaller scale, we see that all the time. So How do you balance that line? Like, what are the data you showing them where you're saying, hey, yes, we'll get you the best price, but let's also be realistic? Because I think it's a pretty delicate line.
Yeah. So we really do consider what the owner thinks the property's worth. And we really consider what their operational and their operating costs and expense ratios were. But when we value a property, it really has little to do with what the current owner thinks it's worth. And I'm talking about when you get past this price per unit and cap and price per square foot, smaller building level. We juxtapose really, you look at a pretty considerably overlapping Venn diagram of what the profiled buyer's operation would look like on that property, and almost 1A or 1B, what does the capital markets think the operating profile for this property will be? What are some of the expense ratios? What are some, even if the property's been running at 2% vacancy historically, lenders are going to say 5, things like that. I don't want to go through all the details, but we kind of paint a picture of here's what the profiled buyer pool that's going to get the maximum value, and the capital markets lending, both debt and equity, think the property is going to be worth. And that's where we come up with our value. Sometimes owners are pleased with what we come up with. Sometimes they're not.
And right now, a lot of not the hindrance, but a lot of the pricing is driven by the debt that can be placed on the property, right? And as everyone's talking about how hot the market is and how cap rates are compressing, a lot of times it is the debt or the capital markets that is sort of capping what property might be worth.
Makes sense.
Yeah. Or ratios too. If it's a mixed use property, there's rules about the percentage of income that could be attributed to a commercial tenant, even if it's CVS, that will restrict the types of debt someone can get on a property, and therefore their levered return is going to change considerably.
What's the time frame? Call it Q1, Q2, first quarter. Someone could expect if they list their building. What do you guys? If I ask you, how long is it going to take to sell my building to get to the closing table? What's the expectation that's out there these days?
It's last 2 pitches.
If I price it right.
Yeah, 60 something million mixed use building priced right is about 95 days. A very complicated scattered site SFR portfolio because of the logistics and the challenges from the capital markets perspective is more like 120 days. Neighborhood smaller buildings definitely can be closed in that 90-day time frame. It depends on how complicated it is. We had one last year that went on for a long time, but there was a development component, affordability component, a condo deconversion, and a land sale.
It's a sexy deal.
Yeah, it took like 5 months. That was everything, working with the village attorney to transition affordability requirements. I mean, that's the Rubik's Cube example. But if it's a straightforward sale and we create a market that we believe in while we underwrite and quote the price and then take it to the buyers, you should be under contract within 3 weeks of taking it to market, because I feel like I'm rambling on, but our process is, when we get an assignment, we strategize how to value the building. And part of that strategy is we have confidential conversations with numerous potential buyers within the buyer pool to hypothetically underwrite the property to know what the market is. So when we believe in that value, we know that there's a market out there. And then it's just up to us to bring all those people we talk to together to compete each other and drive it up higher.
All right. So one last question before we wrap here. I assume you guys get in a situation where you have sellers saying, I'm thinking about selling this, but I also have a ton of equity in it. I can refinance. Even though rates are going up, they're still good. You guys are obviously incentivized to go one way there, but you're also, a trusted advisor to the seller. Talk through those conversations, right? Because that's a very important decision for the seller.
Yeah, I mean, it's a long game. First off, these are $1 million decisions, and there's no salesman or advising against what the right thing to do is. The right thing to do is the right thing for the property and the right thing for the client. So you have those deep conversations with them and ask the right questions and find out what their refinance options are. And if they're able to pull their capital out and retain the property, we advise that. Honestly, if they have to sell, but for some other reason, or recapitalization isn't the answer to whatever problem they're trying to solve, then we're there for them. It's a long game. At some point, they're going to sell the property. And if we continue to advise the right move for their goals along the way, we'll be there. I mean, is there anything you want to add to that, Jeff?
No, that's spot on. And it all depends on their long-term business plan and their long-term plan with the property, right? If it's a long-term hold and rates are where they are right now and they can get long-term debt, why wouldn't you, right?
Yeah.
We would never steer anyone away from that.
Yeah, and on the other side of the coin, we have advised people to pay a $2 million yield maintenance or prepayment penalty to sell because they're in a bad capital position and they're going to have to pay that penalty anyway. And the penalty in a refinance doesn't make as much sense as a penalty in a sale because the underwriting's like 50 basis points wide on sale versus refinance. So there are situations where it does make sense, and we advise that as well. We're not always out for our goals. Obviously, we want to sell properties, but
yeah. And just anecdotally, we have a client looking in Michigan right now or selling in Michigan, who is eating the defeasance penalty because the market is where it is, and a buyer came in and covered not only the defeasance but more than the property's worth. So it always depends. There's no cookie cutter answer.
Got it. Good stuff. All right, Mark, you ready to wrap with the Chicago fact here?
Ready.
All right, and you guys,
I put Mark to sleep.
We'll also get it. You guys will also get a chance. It's multiple choice. So there's 3 people here, 4 possible answers. Someone should get this. All right. So this old railroad bridge has been declared a landmark, forever to remain in an upright position because boats can't pass under it when it's lowered. Is it the Kinsey Street Bridge, the Dearborn Street Bridge, the Wells Street Bridge, or the Madison Street Bridge?
I'm going Dearborn.
Mark and Jeff, where are we going?
The McKinsey.
I think it's Kinsey too.
It's Kinsey. Way to go, guys.
All right. All right.
Feels better when we group team effort, but it feels better when we.
I lived close to it, so I should know the answer. It's right by East Bay. It's always up.
Yeah.
I live nowhere near any of them, and that's why I got it wrong.
I'm a good guesser. That's why I got it right. No, I knew 2 of them go down. So that was part of the thing. All right. So I got 2 in a row. I'm good there. All right, guys. Awesome show.
Thank you.
I appreciate you guys coming on. We'll see you soon again. Listeners, thank you for listening. Please leave us a review. If you know anybody that'd be a good guest or you think could add value to our listening base, please share them or reach out to us directly. Guys, have a good one. And listeners, we'll see you Thursday.
Thanks, guys.
Thanks all.
Thanks.